Welcome to the Shot Caller Bar, where today I will attempt to explain the concept of non-correlating assets via bar-style mixology. Let me first define in basic terms the three different types of correlation we'll be reviewing today in our bar. The correlation coefficient is a range from -1 to +1. A positive correlation is when one variable, say the NASDAQ, goes up at the same time another variable, let's say Tesla. That gives you a +1 correlation. A negative correlation is when the exact opposite would happen. So let's just say stock markets are going up and gold price is going down. Just as an example. A zero correlation or a light correlation is basically when stocks go up and down randomly and there's no direct linear relationship between them. So let me set the scene for you. What we're trying to do is to minimize or avoid a bad portfolio hangover imploding from a stock market crash. The bystander might be the Federal Reserve, the interest rate police, stopping us from getting irrationally exuberant, but occasionally passing out Alka-Seltzer and Gatorade at our little pity party. So, in the zero to neutral correlation category of our bar, we have watermelon. Watermelon is representing corporate bonds. Hangovers are caused by dehydration and low blood flow. The L-citrulline in watermelon has been known to increase blood flow. So it goes with corporate bonds. The correlation with the S&P since 2008 is about 0.05%. And since 1996, it's actually -0.1. So that means when one part of the market's going down, your corporate bonds might be going up. Professional portfolio managers and bartenders love these kind of statistics. Corporate bonds, are not always negatively correlated to a hangover. Stocks. Basically, if you're really blotto, watermelon will not make a difference if there's a wide, deep economic shock. Corporate bonds and stocks can move in tandem for short periods of time or longer. As usual, seek professional advice when you're putting your own portfolio together. We are seeking to inform you on how to put together a good bar and how to get you informed on putting together a good portfolio. In the mildly positive to neutral part of the correlation story and bar, we have bananas, which will play REITs, real estate investment trusts. Because alcohol blocks the production of a hormone that helps your body hold on to water, leading to dehydration again and the loss of electrolytes, potassium and sodium, bananas replenish your body's stores. Like REITs, add cash dividends to a portfolio, but they can occasionally go FML rotten at times, like the 2008 financial crisis, where REITs went down 37.7% in line with the S&P. However, during the 2000 to 2002 stock market drop, REITs outperformed dramatically, being up over 26% in 2000 when the S&P was down almost 11%. So they had a very negative correlation, real estate investment trusts and the S&P. Moving on to negative correlation, we have water. Always a good hydrator, and water is playing the role of gold in this scenario. It's the go-to solution for those wishing to prevent or limit a hangover and a stock market drop. However, there are times where they don't provide protection and you will see that they move in tandem with each other. Gold, will often perform in line with stocks during risk-on periods, but they usually decouple and become non-correlated during periods of economic stress. And that's why you want to consider having gold in your portfolio as a staple. Tips. Treasury inflation protected securities are represented today by our lime and our lemon, as well as government bonds. The rolling correlation between TIPS and the S&P 500 has fluctuated between about -0.2 and 0.2. They'll keep your portfolio intact so you can afford to buy more alcohol. It's the same story with regular government bonds. Treasury bonds and stock bond correlations have changed over time. During most of the 20th century, they were negatively correlated, but have been strongly correlated since the early 2000s. So correlations can change with different economic environments. However, they are often corporate bonds and government bonds, more government bonds, a flight to quality in short-term shocks, and then play a really important role in many bars and the drinks that they serve. Portfolios. They won't give you a buzz, but they will cool and smooth things down when they get hot. In the positive correlation part of the bar, we have gin, a steady Eddie in all bars. I couldn't find a regular bottle of gin, so I will be accidentally plugging at, say, Cologne Gin, which it was the biggest surprise to you as it was to me to find that. However, my husband comes from Cologne, so hopefully I will get lots of support from the Cologne football team and the Hennes fans. Diageo is our gin in our stock portfolio. It's a very large cap stock that up until recently was the world's largest distiller. The correlation to the S&P is about 0.74%, so definitely heading towards that one. Diageo is part of the FTSE 100, which is a large cap UK index, and it has outperformed the FTSE over the last 10 years by a big margin. Investors returned 15.9% over since 2003, dividends reinvested, while the FTSE only returned 9.4% over the same period. Diageo is also paying a 3.32% dividend, which is like getting extra cucumber and fancy pepper in your gin and tonic. Diageo is also a great example of positive correlated stock with a bit of a buffer, because the last thing we want to do when we go through a financial crisis or another global pandemic is to give up our drink. Moreover, Diageo actually outperformed the FTSE by a huge margin while global markets were recovering from the last economic crisis from 2011 upwards, returning 63% versus the FTSE's 16%. Now, as you know, your bartender does not give investment advice nor psychological advice, simply information. Always consult an investment professional when making any investment decisions and a professional bartender when you're drinking. Tesla is our tequila, and it's an example of a highly correlated stock. It has a 0.83 correlation with the NASDAQ and a 0.9 correlation with the S&P, so very nearly one. A deeper look at the recent trading environment, and you'll find that the NASDAQ is expected to generate 7.5 times less return on investment than Tesla. However, the NASDAQ is 3.66 times less risky than Tesla. So keep that in mind. In closing, my goal was to give you some ideas about putting different types of assets in your portfolio that do not move at the same time in the same economic environment, and how that can benefit you in many ways, like not getting a hangover. But the true secret is investing on a consistent basis over time. Time is your friend. Your age and your risk tolerance will play a big role in how much you diversify and the types of assets you focus on. For now, sit down, join me in a little midweek tipple or water. Water is also very good. Lastly, do not forget the tip jar. If you like this video, give the hardworking bartender some tips via share far and wide with fellow mixologists. See what I did there? Sign up for one of our educational but entertaining courses, and we even have a non-alcoholic version for teenagers that they will love, because we talk about iPhones, Teslas, and even rap music moguls. Share wherever you're seeing this video and give us a like. Until then, have a great day. Cheers.